Hello and welcome to our latest Insider interview. Today in the studio, I'm joined by Simon Barnard, who is fund manager of the Smithson Investment Trust. Simon, thank you for coming into our studio today.
Hi, Carl. Thank you for having me on.
So Simon, let's start off with your investment strategy and approach. So Smithson Investment Trust invests in high quality, mid and small cap global businesses. You've got around 10,000 companies to choose from. So how do you narrow down that huge amount of choice?
Well, we take a very long-term view in the companies that we look at. So primarily, as you mentioned, we look at very high quality, but also growing companies. What do we mean by high quality? Those with strong margins, great free cash flow generation, and high returns on invested capital. But what's important for us is those metrics are sustained over time, over the very long term. And what we need to look at to determine that is a competitive environment. So that's really the most important thing, because if the competitive environment is benign, then we know substantially they'll be able to maintain those returns. But if it's very aggressive, then they'll probably be eroded over time. Now, how do we find these very high quality and growing companies? Well, we use many different ways. We've got a team of analysts scouring the globe for these companies, and there are about 10,000 to choose from. So typically they start by using financial screens and then do deep dive research on anything that looks interesting from there. But to be honest, sometimes you just get lucky. Around a year ago, I went to a conference and stumbled into a presentation from a company I'd never heard of. It was called NAPCO Security Technologies. And I liked what I heard so much. After a series of successive meetings with the company, by now we're ending up roughly their fourth biggest shareholder. So sometimes you just never know where it's going to come from.
And you like to invest in companies for the long term in order for their value to compound over time. So Smithson launched in October 2018. Could you provide some examples of companies you've held from the early days?
Well, actually, about a third of the portfolio is still in the same stocks that it was 7 years ago. So we still have conviction in quite a lot of those stocks. But really a couple that I would mention is perhaps MSCI. This is the US-based provider of indices and benchmarking data. Many will know it through passive investing, which has been a great tailwind for them over the years. It's a very steady compounder because now it is also going into thematic investing like sustainability or more recently private assets. So that's been a great performer for us. But actually our best performer over that period has been Diploma. So this is a UK-based company, but it's a very decentralized specialist distributor of industrial products, anything from gaskets for engines to Formula One components. And really the beauty of this business is its decentralization, because what that ultimately means is it owns well over 50 individual companies, and each of those are able to go out into their respective markets and keep adding bolt-ons or small company acquisitions to their own, such that while the organic growth of Diploma is probably only mid-single digit over the long term, 4, 5, 6%. What they're able to do is add another 4, 5, 6% of growth through bolt-on acquisitions. And a lot of these acquisitions are very low risk because they're very small from their subsidiary companies. So that's actually now our largest position in the fund, having done so well.
Your investment approach is to focus on the company fundamentals rather than trying to predict wider macroeconomic movements. However, you have had a lot of macroeconomic headwinds to contend with. In recent years, we've seen interest rates rise in the UK from rock bottom levels to peak at 5.25%. This was a headwind for smaller companies as investors dialed down on risk. Now that interest rates are falling, is this turning a headwind into a potential catalyst for the area of the market you invest in?
Yes, it might do. You're absolutely right. The increase in interest rates since 2021-22 has been a significant headwind to small caps and our strategy in particular, because we look at high quality growing small cap companies which have been doubly hit by the longer duration interest rates going up. So I'm talking about the interest rates on 30-year gilts or US bonds. So we have to be a little bit careful about how we define interest rates, because when we take the Fed funds rate or the UK base rate, which is certainly falling now, that typically tends to affect the shorter term interest rates. So to put that into context, the US 2-year bond rate has come down by about 1 percentage point since the end of 2022. But what typically actually affects us more is the longer bond yields. And so if we look at a US 30-year bond yield, that has gone up around 1 percentage point since 2022. So we have to define that. But of course, if that long bond yield were to start falling, that would be a big benefit to our strategy.
Another macroeconomic headwind has been US tariffs, which have been dominating the headlines so far in 2025. Have there been any companies within your portfolio that have been impacted by US tariffs? And if so, have you made any changes to the portfolio?
They have impacted some of our companies. So initially when they were announced, we thought, funnily enough, the biggest impact would be on some of our medical device companies. Those include Ambu and Fisher & Paykel. That's because they tend to produce their medical products in Mexico and Asia and ship them into what they have is quite a large US business. But because of the nature of their medical devices, actually those were covered by the USMCA agreement, which is the old NAFTA agreement. So actually they could be shipped into the US free from tariffs. So then we went to the next layer down, and we've discovered some of our consumer companies like Clorox, for example, is actually likely to be worse hit than those medical device companies. And Clorox have already said that the tariffs will typically cost them around $100 million, which is just under 10% of profits for this year, as they are having to ship them in from outside of the US. It is also a bit tricky for Clorox because they supply household staples goods, and clearly the one area of weakness that we have been observing over the recent months is the lower end US consumer. So demand for those household staple goods will be impacted on top of that. But do you know, we haven't made any outright changes to the portfolio on the back of this, primarily because of a lesson I learned from my first day of my economics degree at university, which was, the lecturer put it like this: if you have all of the window cleaning companies in the UK and they all suffer an elevated cost from higher minimum wage, what's going to happen to their profits? The answer is very little, because if they all suffer from the same cost, then they can all put up prices and no one will particularly suffer in terms of margin. So that goes again to the competitive environment. If the competitive environment doesn't change, i.e. everyone suffers in the same way, then ultimately what ends up happening is that they can all put up their prices, and sadly all of the additional cost falls onto the consumer. And I think primarily in most of the markets we're looking at, that is what's occurring. In fact, many of our companies have already told us that they've put through what they call surcharges to their customers to cover the additional cost of tariffs.
Sticking with the US, I noticed that you've been increasing exposure to US companies. Could you explain why? Of course, at the moment, there's no shortage of commentators predicting the potential end of US exceptionalism. And also the US dollar has been weak in 2025. So why have you been increasing exposure to the US?
There are a lot of fears about the end of US exceptionalism. I don't have a crystal ball. It might happen, it might not happen. So that is a big uncertainty. But what I do know is that the US remains a very attractive place to do business. It is a very large domestic market, which is important for our small and mid-cap companies, because typically smaller companies rely more on their domestic market than international markets, because frankly, they haven't expanded to a size where they're growing to other markets yet. And so for our small and mid-cap companies, the US is still a great place to find these opportunities. What I also know is that since that Liberation Day announcement by President Trump, a lot of our fantastically high quality, fast growing companies have come down significantly in valuations. So that is a fact today. Therefore, all we've simply been doing is take advantage of that and adding companies, which in some cases we've been following since inception 7 years ago and never had the chance to buy, now at valuations that are attractive to us. So that's the reason it's gone up. No real bet on what's going to happen to US exceptionalism.
And could you provide one or two examples of US companies that you did add exposure to over the past couple of months?
Yeah, Qualys is one. So this is a clearly US-based cybersecurity company, and it focuses on vulnerability detection and management. So it puts very small agents on corporate networks, which finds every asset connected to that corporate network and then remediates any patching that's required. So automatically patches all of those devices such that the vulnerabilities are eradicated. Now, this is increasingly important in a cloud computing environment because the network essentially grows exponentially. And so we don't see any decrease in the required demand for that product. In fact, it's growing quite rapidly. And yet those share prices have become discounted in a weaker US market. So we took advantage of that.
As mentioned, you have a long-term investment approach. The portfolio turnover is around 25%. Is that higher than you would like it to be? And could you talk us through recent portfolio activity?
Well, I don't think 25% is a particularly high number in absolute terms. Most active managers on average are above the 60 or 70% annual turnover. So it's not high in absolute terms. Obviously, we'd like it to be zero because that means we're happy with everything and nothing's changed and we can just sit on it and allow it to compound in value. But ultimately, and particularly in small cap, there are a few reasons why we find that we have to make some change in the portfolio. And those are really fourfold. I'd say the first and most important one is when the management of these smaller companies, who tend to have quite a lot of power, make a strategic shift that we don't agree with. And that's happened a couple of times to us. Masimo in the US is a good example. It still is a US medical device company, but they overnight decided to buy a audio equipment business, which we found very confusing and ultimately didn't work very well. We sold out on the back of that. Another good reason is if our small companies, which tend to focus on particular growing niches and markets, sometimes those niches and markets don't work out very well. So sometimes we make a mistake on that, and clearly it's better to exit if we have done that or if that market or niche has changed. Thirdly, small and mid caps, as I'm sure everyone notices, are typically have more volatile share prices than large caps. So we tend to take advantage of that where we can. We've just been discussing Liberation Day and the benefits on valuation that was born out of that, where we took advantage of that. But on the flip side, a couple of the positions we sold this year simply got too expensive. They worked very well. One was Verisk. This is a company we owned since inception, had been one of our best performers, and only recently had reached a valuation that we no longer felt comfortable with. So that was another reason to sell. And finally, we would typically sell if we find something better. Which is a combination of all of those factors. And what you have to bear in mind is, in a closed-ended structure like a UK investment trust, ultimately, if we do find something better than we already own in the portfolio, we're going to have to sell something to raise the capital to buy something. So that 25% actually means that we have sold 12.5% of the portfolio to be able to buy 12.5% of the portfolio into something else. So when I describe it in that way, it actually doesn't sound like a lot of activity in absolute terms. So a couple of new ideas that we've added to the portfolio, which are based in the US as it happens. One is Vertiv. This is the leading provider of liquid cooling technology for AI-powered data centers. And so this clearly is in a growth market. It's currently growing at about 30%, which would typically actually put us off because obviously it would be a darling of the market and something that we would typically find too expensive. However, in this case, after the DeepSeek revelation in January of the low-cost Chinese AI model, a lot of these AI-based suppliers fell quite precipitously in share price, and Vertiv itself was down 60%. So it was actually on the back of that move that we decided to pick up what was a very attractive growing business at now a very interesting multiple. Interestingly, it has since bounced, so it is less cheap than it was, but it's done well for us in the meantime. And another new company was Napco Security Technologies. This is the one that I discovered in a investor conference, and they produce security technologies such as panels, alarms, both fire and burglar, and remote locking systems. And this is quite an interesting company because over time, since about 2018, They have increasingly sold alarms and remote locking systems which carry a recurring revenue to keep them connected to the cloud. And so it's gone from a pure equipment business, which only had a gross margin of about 25%, to now about half their revenues recurring revenues, and that carries a 90% gross margin. So you might imagine that the economics of the whole business has transformed dramatically over the last few years, and that part of the business is the one that's growing quickest. So again, we see a lot of opportunity for that company in the future.
Simon, thank you very much for your time today.
It's been a pleasure. Thank you, Carl.
So that's it for our latest Insider interview. Hope you've enjoyed it. You can let us know what you think. You can comment, like, and for more videos in the series, do hit that subscribe button. And I'll hopefully see you again next time.